Uh, my name is Michael Grandy. I'm a professor at Providence College. I'm recording this video as part of my MBA 603 class, which is essentially managerial accounting, making business decisions. The textbook, as you well know, we're using the Garrison, Noreen, and Brewer textbook. That's the 17th edition. And the topic of today's video is going to be a narrated PowerPoint presentation regarding Chapter 2, specifically job order costing, calculating unit product costs. And as a quick overview, product cost is made up of three very important things: direct materials, direct labor, and manufacturing overhead. And what we're going to see is that it's generally pretty easy to trace or identify direct materials to a particular job. Direct labor is also pretty easy to trace to a particular job, but manufacturing overhead is a little bit more difficult. So let's set the context for job order costing. Let's assume that you're an accountant and you have a client who builds homes. And many of you have been through a neighborhood where they've cleared the land and some developers come in and decided to build a plat of houses. Maybe got a big piece of land and they put a road in, and they put, let's assume they're going to put 20 houses up. They're going to construct 20 houses on this piece of land. So this is a very classic example of job order costing, because the developer, the builder, wants to know exactly the cost of building each house. Because at some point in time, that builder wants to know what his gross profit was on building that house. Well, what's gross profit? Sales revenue minus the cost of goods sold equals gross profit. The sales revenue will be the sales price of the house. The cost of goods sold is going to be made up of three things: direct materials, direct labor, and overhead. Direct materials for a house. Pretty simple, right? Wood, concrete, electrical, hardware, asphalt, cement, concrete, you know, all the materials that go into building that house. And that can be easily traced, right? If you're building a house on lot number 1, you have the lumber that is delivered to lot number 1. It's on the lot, and you code it, you identify it, and that's the direct materials that go there. You can also keep track of the direct labor because you can identify the workers, or sometimes the subcontractors, that work on each house. So plat number 1, you have the employees that are working there for those days. You can calculate, keep track of their salary, the number of hours, and the subcontractors when they work on plat number 1. So direct labor, again, you know the definition, the wages and salaries of employees who assemble the product. You can trace the labor to plat number 1. So you have direct materials, the wood, the concrete, the hardware, the plaster, the boards, the electrical work, all that stuff. You can trace it to lot number 1. The employee wages and the subcontractors, you can also trace that to lot number 1 versus all the other lots, right? But overhead, how do we allocate overhead? And you remember what overhead is. Manufacturing overhead is comprised of three things: indirect materials, indirect labor, and other factory costs or other costs that go into building those houses. So we're going to talk about coming up with an allocation method to allocate manufacturing overhead or overhead to each one of these jobs. So essentially, that's what Chapter 2 is all about. It's about tracing product costs to each particular job. So let's start with the PowerPoint presentation. I'm going to share my screen. We can walk through this together. And you should now have that there in front of you. Let's keep it right there from the beginning. Okay. So you should be seeing the PowerPoint presentation at this point. And Job order costing, calculating unit product cost. Job order costing systems are used when many different products, sorry about that, when many different products are produced each period. Okay, this is not process costing. Process costing is where you produce one product all the time. Same product, mass production. No, job order costing is the houses, right? House on plat number 1 may be completely different than the house in plat number 2, especially if they are made to customer order, right? Someone comes to you and says, okay, I want you to build a house on this lot. This is the plans that I want. These are the number of bedrooms I want. These are the types of finishes I want. I want to have, I want to have marble versus, some cheap material. I want to have hardwood floors as opposed to carpet. I want to have, certain types of finishes that are more expensive than the other one. So we need to keep track of it. Products are manufactured to order, okay, to customer specifications. The unique nature of each order requires tracing or allocating cost to each job and maintaining cost records for each job. So we want to know exactly what plat number 1 cost versus plat number 2. Some examples, I gave you the house builder, but there's some other things like Boeing, they build aircrafts. Bechtel International, large-scale construction, Walt Disney movie productions. They want to keep track of the costs specific to that project, to that order. So again, you may have 3 different jobs going on. Job number 1, job number 2, job number 3. In my house builder, plat number 1, plat number 2, plat number 3. So direct materials and direct labor, you want to trace those to each job. What direct materials, what wood, what electrical materials, what concrete, what sheetrock, what roofing materials went to plat number 1 versus plat number 2 versus plat number 3. And then the labor costs associated with building a house on plat number 1, the labor costs associated with plat number 2. So we want to be able to trace them to each particular job. The third component, manufacturing overhead, which I talked about, includes indirect materials and indirect labor, are allocated to all jobs rather than directly traced. It is virtually impossible to trace overhead to any particular job. So what we want to do is come up with some sort of allocation factor. Now, this is a job cost sheet, and this is a piece of paper, and it's easy to look at things as a piece of paper, but as you can well imagine, these things are done electronically through a computer. But you can see here, they identify the job up in the upper left-hand corner. And on the very bottom, well, halfway through, they keep track of materials, labor, and overhead. And then they have a cost summary, direct materials, direct labor, manufacturing overhead, total cost. And then you're going to come up with a cost per unit. Cost per unit, what is total cost divided by the number of units, okay? Here's an example of one job that's going on. And what's important now is to begin to think about quantity and price. Because later on, when we start doing performance reports, breaking down quantity and price is important here. So you can see with regard to direct materials, they have quantity and price. They got 12 feet of 2x4s at $3 for $36, right? Quantity and price. And then they've got some 1x6s, also 12 feet. And they use 20 of those, and the cost is $4 each. So their direct materials cost is $116. And then they put that on the job cost sheet. Here's a timesheet where this particular employee was working on this job. This employee put 8 hours of work into it, and the labor rate was $15 an hour. The direct labor is $120. And you can see where we can trace that to that particular job. But when it comes to manufacturing overhead, we need to come up with some way to allocate it to these jobs. So we're going to spend a little bit of time talking about predetermined overhead rates. An allocation base, such as direct labor hours, direct labor dollars, or machine hours, is used to assign manufacturing overhead to individual jobs. We use an allocation base because it is impossible or difficult to trace overhead costs to a particular job. We can't trace all those little pieces of indirect materials, indirect labor, and other factory costs to each particular job in a way that we do with direct materials and direct labor. Secondly, manufacturing overhead consists of many different items, as we just talked about. And lastly, many items of manufacturing overhead costs are fixed, even though output fluctuates during the period. Because I'll tell you right now, and we're going to see this later on, that manufacturing overhead is a mixed cost. Well, what does that mean? It's a mixed cost. That means it has some fixed cost and some variable cost. We talked a little bit about this in chapter 1. We're going to talk about it a little bit later as well. So we need a formula. So here's how we allocate manufacturing overhead. The predetermined overhead rate used to apply overhead to jobs is determined before the period begins. It's a predetermined overhead rate. What we essentially do is we need to look forward, and that's what managerial accounting is all about. It's about looking forward and estimating what the total manufacturing overhead is going to be for the upcoming year. They take a look at all of it, they look at historical information, and they adjust it for what they know might change. Again, let's remember what goes into manufacturing overhead. Indirect materials, indirect labor, and other factory costs. And during chapter 1, we had some examples of what they were. So here's our formula to come up with the predetermined overhead rate. The numerator is total estimated manufacturing overhead costs for the coming period divided by the total estimated units in the allocation base for the coming period. Now, the denominator can be total estimated direct labor hours. It can be total estimated direct machine hours. It can be a lot of different things. So ideally, the allocation base is a cost driver that causes overhead. It really is dependent on what's going on in the factory. If the factory, the manufacturing facility, is heavy manual labor, where employees are constantly putting things together, such as a furniture company, where employees are cutting wood, where they are sanding and assembling desks, well, direct labor hours is probably a very good cost driver. However, if our manufacturing facility is heavily automated, where there are machines that are making our product, then maybe machine hours is a more appropriate allocation factor. The need for a predetermined overhead rate. Predetermined overhead rates that rely upon estimated data are often used because actual overhead for the period is not known until the end of the period, thus inhibiting the ability to estimate job costs during the period. We want to know, we want a really good estimate of what it costs to make our product. And one of the big numbers in coming up with the cost of our product is manufacturing overhead. Actual overhead costs can fluctuate seasonally, thus misleading decision makers. So the overhead may be higher in January than it is in June. So you don't want to use the actual information from January because it'll affect what happens eventually in June. So we need a blended rate. Here's how we go about computing the predetermined overhead rate. Number one, you need to estimate the total amount of the allocation base, the denominator value, the bottom number, right? That will be required for next period's estimated level of production. If you're using direct labor hours, you need an estimate as to how many direct labor hours you're going to have for the year. If you're going to have machine hours, you need to estimate the number of machine hours. Secondly, you need to estimate the total fixed manufacturing overhead cost for the coming period and the variable manufacturing cost per unit of the allocation base. So remember, the definition of a fixed cost is the total cost stays the same as volume changes. For example, rent on the factory. If the rent for the factory is $120,000 a year, that's it. It's $120,000, regardless of the number of units you produce. You need to come up with the variable costs. So the total variable cost is a function of two things: the variable cost per unit multiplied times the number of units, or in this case, the allocation base. So you need to have a variable manufacturing overhead cost per direct labor hour multiplied times the number of labor hours. So in number 3, we're going to use the following equation to estimate total cost. And we saw this formula before in chapter 1, where total cost equals Y, and A equals the fixed cost plus B, which is the variable cost per unit, times the allocation base. Total cost equals fixed cost plus variable cost. And then we can compute the predetermined overhead rate. Again, how do we calculate the predetermined overhead rate? Total estimated manufacturing overhead dollars divided by the total estimated activity base. Applying overhead cost to jobs using the predetermined overhead rate. So here's an example. Peer Company estimates that it will require, remember it's estimated information, 160,000 direct labor hours to meet its upcoming period's estimated production level. In addition, the company estimates total fixed manufacturing overhead costs of $200,000 and the variable manufacturing overhead cost of $2.75 per direct labor hour. So the formula here walks you through calculating total cost, fixed plus variable, the $200,000 of fixed cost, plus the variable cost, which is $275 per direct labor hour, times the estimated direct labor hours. The numerator, the total estimated manufacturing overhead, is $640,000, divided by the total estimated activity base, the allocation factor of 160,000 hours. The predetermined overhead rate is $4 per direct labor hour. So with that number, we can go ahead and now complete our job cost sheet. Remember, we had materials of 116, we had direct labor of 120, and now we can allocate manufacturing overhead to this particular job. They put 8 hours of direct labor, and the predetermined overhead rate is $4. Manufacturing overhead allocated to this job is $32. We can now finish our worksheet. Total cost is $268. What is the cost per unit? Well, we're going to look up in the upper right-hand corner of this job cost sheet, and we know that we completed 2 units. So the total cost is $268 divided by 2 units. The cost per unit is $134. Here's another example. Job WR53 at NW Lab Inc. required $200 of direct materials in 10 direct labor hours at $15 per hour. Okay, once again, let's keep in mind quantity and price. 10 hours, $15 an hour, $150. So you got direct materials of $200, you have direct labor of $150. Third component of product cost is manufacturing overhead rate, is manufacturing overhead. So the question is, how much overhead gets allocated to this job? Well, before we do that, we got to come up with the predetermined overhead rate. And again, that's the total estimated overhead divided by the activity base, multiplied times the number of hours. So here they estimate overhead to be $760,000, and the estimated direct labor hours 20,000 hours. What would you record as the cost of the job? So predetermined overhead rate is $38 per hour. We got direct materials, which we just talked about. We got direct labor at 10 hours, $150. And manufacturing overhead, because manufacturing overhead is allocated based on direct labor hours, you got 10 hours at $38, you got $380. So the cost of this job, which includes direct materials, direct labor, manufacturing overhead, $730. So this begins to talk about the accuracy of the allocation of manufacturing overhead. Inaccurately assigning manufacturing overhead costs to jobs adversely influences planning and decisions made by managers. Well, the question is, what's the true cost of making our product? Okay, that's essentially what it comes down. Managers want to know, with as much accuracy as possible, what it costs to make the product. Why? Because oftentimes the selling price is determined based upon cost. And we saw an example, if we think back to case 1-26, we had an illustration where a company came up with the cost of their product, and the cost was used to determine the selling price. So if we have an overinflated cost, then our sales price will be too high, and some would say that, what's the problem? Well, the problem is from a competitive standpoint. We need to be as competitive as possible. If our price is higher than the competition, then we're not going to do very well. So we need to have the most accurate cost possible so we can have the most competitive sales price. So here it goes on to say, job order costing systems can accurately trace direct materials and direct labor costs of jobs. We just talked about that. Job order costing systems often fail to accurately allocate manufacturing overhead costs used during the production process to their prospective jobs. So it's very important to choose an allocation base. So job order costing systems often use allocation bases that do not reflect how jobs actually use overhead resources. The allocation base in the predetermined overhead rate must drive the overhead cost to improve job cost accuracy. A cost driver is a factor that causes overhead costs. Many companies use a single predetermined plant-wide overhead rate to allocate all manufacturing overhead costs of jobs based on their usage of direct labor hours. Why? It's often overly simplistic and incorrect to assume that direct labor hours is a company's only manufacturing overhead cost driver. If more than one overhead cost driver can be identified, job cost accuracy is improved by using multiple predetermined overhead rates. So what is that saying? What that's really saying is that companies initially used one single predetermined overhead rate, direct labor hours, because that's what they kept track of. They kept track of direct labor hours because that's how they paid their employees. They had timesheets where people punched in, and they kept track of direct labor hours. So that information was available. So that's how they kept track of it, and they used that as an activity base. But now that companies have become more sophisticated, they're keeping track of other things, and they're able to find other allocation factors, other allocation bases. So they can use multiple predetermined overhead rates. We're going to see an example. Compute the total cost and unit product cost of a job using multiple predetermined overhead rates. So here's a great example. Again, got to pay attention to the details because there's a lot going on in this one. Dixon Company has two production departments, a milling and assembling. The company uses a job order costing system and computes a predetermined overhead rate in each production department. So we don't have one single plant-wide predetermined overhead rate. We have two predetermined overhead rates, a predetermined overhead rate for milling and a predetermined overhead rate for assembling. The predetermined overhead rate in the milling department is based on machine hours, and in the assembly department is based on direct labor hours. So we have different allocation factors. The company uses cost plus pricing and a markup percentage of 75% of total manufacturing costs. Now, we had a problem earlier in chapter 1 where the company used a desired gross profit margin to arrive at the sales price, and that was cost dollars divided by cost percentage. This is a different method. Company uses a cost plus pricing and a markup percentage of 75% on cost, markup on cost, to establish a selling price for all of its jobs. At the beginning of the year, the company made the following estimates. So we got two departments. We got milling and assembly. They kept track of machine hours and direct labor hours for both. But remember, milling is using machine hours. Assembly is using direct labor hours. Total fixed cost in each of those departments. And there's a variable cost per machine hour, per direct labor hour. Remember, total cost is fixed plus variable. Calculate the predetermined overhead rate cost for each department. So the first step is to calculate total manufacturing overhead. So the milling department's fixed cost plus $2 per machine hour multiplied times 60,000 machine hours. Total estimated manufacturing overhead for milling, $510,000. The assembly department, the fixed cost is $500,000 plus the variable cost, which is $375 per direct labor hour multiplied times 80,000 direct labor hours for $800,000. So now we're going to come up with a rate, right? The rate is total estimated cost divided by the activity base. For milling, $8.50 per machine hour. Assembly, $10 per direct labor hour. Calculate the amount of overhead applied from both departments to a job. Use the predetermined overhead calculated on the previous slide to determine the overhead applied from the department's job 407. So remember, milling is machine hours, assembly is direct labor hours. They throw it in there to confuse you. So for milling, $765, assembly, $200. We can look at the job cost sheet, and each of these departments has materials, labor, which are not in question, and then the manufacturing overhead applied from the previous slide. The selling price of job 407, assuming a 75% markup, okay, markup on cost, not desired gross profit margin, markup on cost. The markup is 75% of the cost. There's the markup, there's the selling price. Multiple predetermined overhead rates. When a company creates overhead rates based on activities that it's performed, it's employing an approach called activity-based costing, which we're going to see in another chapter. When it comes to underapplied or overapplied manufacturing overhead, we're going to talk about that in chapter number 3. I'm going to stop sharing. We're going to stop the PowerPoint presentation there. And that was an important video because it really talked about product cost, materials, labor, and overhead, and more specifically, how we begin the discussion of allocating overhead to our particular job. So thank you. That's that PowerPoint. Thank you.